Now let's start with the numbers, because December was a confusing month for most and everyone was like expecting a massive Santa rush rally. But instead we got Bud Simpson shop and low volume. Yet our portfolio ended the month significantly up. We were 100% in gold, while Bitcoin more or less did nothing. Can you break down the December performance and explain how the system found alpha in that market?
Yeah, so basically our system performed pretty well. We had 4% gain in December, which was pretty good if you consider that, as you said, the crypto markets were pretty much super boring and went down. And it also outperformed Bitcoin by about more than 7%, and also outperformed Ethereum by about 8%. So it was quite a good month if you just look at the numbers. Now, how does it work? How does the system work, and why were we allocated to gold? I think we already talked about it in the podcast before that.
Yeah.
But yeah, basically the system and the strategy, how it works, is it asks two very fundamental questions. First of all, it asks, should we be invested in the crypto market? Yes or no?
Yeah.
And pretty much since the 11th of October, this question was answered with no, we shouldn't be invested into the crypto market, which means the only options for us were, and now we come to the second question, if we're not allocated to crypto, where should we be allocated? And then the system goes through multiple assets, right? It can be gold, it can be euro, it can be gold, precious metals, and then it decides which one of those is the strongest to hold, right? Because obviously, if you have a strategy which goes into cash while crypto goes down or just performs super bad, you obviously outperform the market and you have a superb performance. But you can have an even better performance if instead of only holding cash, you leave more room for options. And for example, our gold trade, I think when we went in, it was at 4,212. And it ended the month at 4,510 or something like that. So a good 5 to 6% gain. Whereas, if we were to just stay in cash, it would have been flat. So we can get those extra percentages out of the market. And this is what our strategy was showing. And this is why we were allocated to gold.
And you know what's interesting? Well, as you said, we have been talking about this in the previous podcast as well. So everyone who was listening to this, at the end, we actually shared the portfolio that we had going into December and could have basically also made not the exact same trade, but a similar one. And we opened the gold position, I think it was the 27th of November or something.
29th, maybe. I don't remember. Yeah. Something like that.
So, yeah, you could have been doing the exact same thing as we did.
And we will share also at the end of the video.
Exactly. Now, what we will do at the end of the video as well is, again, share our ideas and positioning going into the next month. We are actually recording this at the start of January, so we already have an idea of what is going on. So, yeah. A couple of things have developed. Now, you already talked a bit about like how the system works. So I will leave out that section where you explain it. Now, let's talk about like the invisible trap, because one of the scariest things you have been highlighting throughout the month was were the funding rates. Prices were completely flat, yet funding rates were spiking. For the average listener, why is this a silent killer? And how did spotting this save us from getting wrecked in those random rigs down?
Yeah, so that's a very good question. And I guess it is something that everyone has access to, because you can look at the silent killer. You can go on the website called velo.xyz, which is pretty much available to everyone. And what is depicted there is just the aggregated funding rate. Now, what is the aggregated funding rate? And by the way, if you want to set it up, you just go on Velo, the chart will be opened, and then you click on indicators and then on aggregated funding rate. And basically, what does that tell you? It tells you the position of futures traders. So what's a futures traders? It's just people that trade with leverage or with derivatives, to make it more simple for you. And basically, it measures the intensity or the direction of positioning of these traders. What does that mean? It means if a lot of people are long, which means they buy leveraged or derivatives of Bitcoin, for example, it can be a 1x, it can be a 2x, 3x, all of you know how it works, then the green box will be very high, because it shows you that a lot of people are longing Bitcoin. Inversely, if the candle is extremely red, and if it's big and red to the downside, it means that most of the market participants are shorting the market. Now, how can you derive alpha from that indicator? There's a phenomenon in the market, and I mean, it's pretty known, right, that leverage traders get liquidated or that they lose money. And it is actually true. There's open source, there's like Hyperliquid. It's a derivatives platform where you can see that most traders lose money, right? Especially those that trade leverage positions. What that tells us is that the market tends to punish these traders before it goes in a certain direction. Let's say the market is neutral, so we're going sideways, and a lot of people are shorting the markets, which means they're betting against the price of Bitcoin. They say, I think we're going to go down. I think it's over. Let's short this shit. All right. And then they click on the red button, maybe a 2x, maybe a 1x, whatever. And then you can see that on Velo, big red boxes. And then what happens is that most of the time, even if the market wants to go down because of the macro forces, because of the forces of the market, it will go up first to liquidate all the shorts before going back down. And that is one way of liquidating futures positions. But what happened in December was something similar. The longs got liquidated or they had to close their positions. So basically price was going sideways. Funding was going through the roof, which means that a lot of people were longing the markets, but the prices stayed sideways, which means that long futures positions had to get closed. Why is that the case? It's because people can also close their position because they have to pay a certain amount of fees every 8 hours, right? And if you do that for days and days, and the price does move, you're losing a certain percentage of your capital over and over and over. And it forces people to close their position. And in general, if the green boxes are very high, you can expect the opposite to happen or prices to stay flat. And in our case, if you have a lot of green boxes, it means that it's unlikely that the price is going to go up. And I hope it was easy to understand, but yeah, that's pretty much what happened.
Just think of it like you have a subscription to a trading channel. The subscription is $50 a month, but you are not making any money through the subscription. At a certain point, you will close or cancel the subscription. And because you have to, right? Because it's a net negative trade for you. And this is basically what happens in ranging markets when funding rates are going high. Like people are longing, longs are getting too expensive. They eventually need to be closed, and this then leads to the price going down. This then leads to other long positions being liquidated. So this is basically it in maybe simpler terms. But I explained it quite well, man. So another thing that you have to understand is that in ranging markets, when you have a lot of people with the same idea and everyone is longing the market, obviously there is no alpha in that idea, right? So this is also something that you can read out of the funding rates. If everyone has the same opinion, but the market is obviously not going in that direction, what is the next logical step? Like for me, it's not just like looking at data and like thinking that is the case and like doing some data mining or whatever. But it's also, in my opinion, just logical that we have those types of moves. And this is something that I thought of a lot recently, that if you have something like the funding weights, which might sound very technical, but it's based on logic and on human behavioral patterns, right? So just one quick thing, when you have when you have something like this, always understand or try to understand why you get alpha out of those like specific things or specific data points that you're looking at. Because if you can explain it, it's much easier to trust the system or the thing that you're looking at. And this is why we are able to make decisions based on funding rates without second guessing them, because they are based on logic. All right, we spent the whole month talking about the gamma pin and the massive December 26th option expiry. You predicted price would be stuck below 90K until that specific date. Played out almost to the hour. Explain what a gamma pin is and why market structure often matters more than news headlines.
All right, so I just explained the futures a little bit in depth, so I'm not going to spend too much time on that because it's also a little bit of a more complicated topic.
Yeah.
But basically, because we spent some minutes now with that, options are a pretty big part of TradFi, right? Of traditional finance, the stock market, etc. And now that crypto is becoming more and more mainstream and included into the TradFi system, it has some similarities, right? And now options are, if you also look at how much volume options take out of the market, it's growing every year. And you see more and more people trading options. Now, what happened the 26th of December is that you had a quarterly option expiry, that you had a half year, I forgot the name, semi-annual maybe option expiry, and then you had the annual option expiry. So what is and they were all coming together. So what is an option expiry? It just basically you're betting on Bitcoin price reaching a certain level by a certain date, right? And all of these contracts were expiring the 26th of December. And most of the people were betting Bitcoin to be between 85 and 90,000. And because these are big institutions and big players placing these bets, they have a high incentive of price, moving between these two levels. For example, if it reaches 90 and it wants to go above, they were hammering the sell button. If it was going to 85 and below, they were hammering the buy button. And that wall got lifted on the 26th of December. And this is where you saw volatility return to the market.
Got it.
Especially after that event.
So it's, as you said, a bit complicated. We won't go into depth. If you are interested in that, just Google the term gamma pin, maybe, in combination with December 2025 for crypto. And I'm sure you will find some good information. All right. Now, let's get into the silver mania, because this was also an historic event, actually. On December 27th, things got crazy. Silver pulled a 4 sigma event. For normal people, this is a very unusual event, jumping 11% in a single day, and gold hit $4,500. We were fully allocated there. Was this just luck, or did the macro signals actually predict this end of parabola blow off top before the crash back down?
It's pure luck, man.
Pure luck.
Like
shiny object, right?
Shiny object goes up. Nah, but basically, yeah, silver, actually a member of our group was calling silver. And why are we investing into gold and not in silver? And my systems were actually long silver, but for me, there was no safe and liquid option on the blockchain to buy silver. I'm not an expert when it comes to stocks and brokerages and all of that. So I just, I'm a crypto guy. I want to stay in my bubble. Maybe it's good, maybe it's bad. I don't know. But gold, you can buy it on the blockchain. And this is why we bought gold. And yeah, I mean, silver went through the roof. As you said, it was a very unlikely event because the move was hyper aggressive. Just to put it into perspective, like you said, it moved 10% in one day, right? And it's I think currently it's also the second, maybe again, it's the third biggest asset in the world. So for people that say, yeah, the bigger Bitcoin gets, the less volatility it has, it's not necessarily true, right? And if you look at the gold chart, it actually, after end of 2023, went absolutely parabolic, right? So you can see on the chart, for example, it was actually ranging for 10 years. And then it started like pretty much in February of 2024, and it just went, it 2x'd since then. So it made 100% in pretty much, like 2 years, you can say, which for gold is massive. But yeah.
Got it. So it wasn't luck.
I don't believe so, though.
Got it. All right.
Our systems are just designed to catch big trends. And that was a huge trend developing in gold and in the precious metal market. And not only in gold and silver, but all the other precious metals as well.
Yeah. Copper also went quite wild on that day. Now,
we will just look to, like, as more and more assets get tokenized, we will capitalize on that. And, we will include more and more assets into the portfolio so that even if crypto goes sideways for a decade, like gold did between 2011 and 2024, right? 13 years of sideways from all-time high to all-time high. You don't want to be sitting there and earning no money.
Exactly. And I think it's also a good thing that we stay on the blockchain just for the sake of speed as well.
And safety.
And safety.
And sovereignty more.
Yeah. So, I mean, when you have to transfer funds from one brokerage account to another, like I would say like a cash transaction takes about 2 days, maybe. And when we think about silver, this is a move which you had to catch like very fast. Gold, I would say you had some time to play it, but with those types of moves, speed is quite important. And for that reason also, I would say staying on the blockchain is beneficial. And as you said, like we will have more and more assets on the blockchain, also stocks that are being tokenized, and like even private equity is available on the block, or is slowly getting available on the blockchain, like tokenized private equity. So I feel like staying on the blockchain and just being an absolute one of the best like players in that space and being able to understand how to use like all of those technical things is just a huge advantage that maybe doesn't seem like a huge advantage yet, but will be a huge advantage in the next like 5 years. So you had an interesting theory, or shared an interesting theory. I don't know if you remember the banana zone rotation theory. When I first heard this, it was quite funny. But yeah, you have been teasing the banana zone rotation theory real quick so you understand what it means. Basically means capital flows from gold, then to silver, and then into Bitcoin. Silver just crashed 15% after the mania one. So does this flush signal that phase 2 is over and the phase 3 rotation into Bitcoin is officially starting now?
So the banana zone rotation theory is pretty crazy. It is crazy in a sense that liquidity flows fast and aggressively from one asset to another, and it can lead to crazy pumps and crazy results like we have seen with gold, silver. And now the theory is that this liquidity might flow into Bitcoin. So what is the reasoning behind it? The reasoning behind it is that the TradFi market is intertwined, and liquidity flows from one asset class to another. For those of you that are more native to the cryptocurrency space, you can imagine it like that. It is like Bitcoin pumping first, Ethereum pumping second, and then you have altcoins pumping, right? And you can kind of see it in the same lens if you are in TradFi. You have stocks going up first, or maybe, stocks, then gold, then silver. You can say that gold and silver, they move like Bitcoin and Ethereum as the first precious metal versus the second precious metal. And once the big assets have pumped, for TradFi, Bitcoin is a beta asset, right? It is more of a risk-on asset, right? So now the theory is that after the big boys have pumped, some liquidity will flow into the smaller caps and also into Bitcoin. So we already saw also the IWM, which is the shitcoin stock basket, which is pretty much small caps in the stock world, and they're going for all-time highs. Man, they're breaking out. And also, if you look at the small caps versus Bitcoin versus big caps charts on the stock market, I think the chart looks pretty beautiful here, and it looks like it could break to the upside. So risk on for me seems like it's back, and I think it's a pretty reasonable theory to say that, small beta or beta coins and stocks will pump after the S&P 500. And also you can measure that by breadth, which measures pretty much like how many stocks are above the 200-day moving average. And historically seen, right, when you have values of 75, it means that 75% of stocks are above their 200 moving average, which means that all stocks pump together, and it's not only the top stocks, which means if all stocks pump together, it means that also the small ones are pumping. So that is a good indicator, and it's going up, and it looks like it wants to go to the 75% level, which historically seen, last time we have seen this in February, March of 2024, which was a big euphoria zone. So that is the theory behind it. Will it really happen? I don't know.
It's just a theory. Yeah. So nothing that you should trade on. Just you need a system. It's a theory. Don't rely on stuff like this, because obviously it's something that you can keep in the back of your mind to explain why certain things are happening and be more confident in your decisions. But the signal that you should act upon should be your system. So, and this is just like the additional confidence you gain. Now, here is the chart most confusing for people. Global liquidity is actually hitting all-time highs, meaning the money printers back on, yet Bitcoin is lagging behind. You called this divergence a massive catch-up opportunity. Why is this specific setup the cheat code for early 2026?
Yeah, so basically global liquidity is tightly correlated with Bitcoin. And what is global liquidity? It is a mix of the balance sheets of certain central banks, as well as the money supply of different countries all put together is global liquidity. Very simplified view. And basically, if you run some statistical tests on that, you can see that it's actually pretty correlated. Now, that doesn't mean that global liquidity, if it goes up, Bitcoin follows it, with a one-to-one correlation. It just means that overall, there's a pretty high correlation between the two. And right now, we're seeing a massive divergence between the two metrics. So global liquidity is going up, while Bitcoin was even going down and sideways. And now we have like a huge gap between the two, which typically gets closed pretty fast, right? And that can mean one of two things. First, global liquidity goes down and goes back to Bitcoin's level, or Bitcoin catches up with global liquidity. And I believe it's the latter. I think that Bitcoin will catch up to global liquidity. And I think that the banana zone rotation theory is more likely to play out. I think that also, if you look at the Bitcoin versus gold chart, you also see that it has reached oversold levels, which we have only seen in bear markets, right? So if I were to put out the RSI, do I even have it open? Yes, I have it open. I will quickly display a chart here, which pretty much shows you the last few times that gold was this, overbought versus Bitcoin. And so the last time was here, 25th of July, 2022, which was like the bear market bottom, for those of you that remember right now. Then we can use February 19th. What happened after that? One of the biggest pump we have ever seen. So I think it's looking pretty good here. Obviously, this is a very simplified strategy, model, right? And of course, you need some risk management and professional systems to navigate the markets. But I think just from a macro perspective, in the next 3 months, it's looking pretty good. Now, after that, there's some pretty big risks hitting the market, especially the stock market, which make me a little bit more cautious. But for the next 2-3 months, I think we catch up to gold. I think we catch up to the S&P 500, and I think we catch up to global liquidity.
Yeah, there are just a lot of things that are aligning right now, right? And this is something that you usually are not seeing. So for me as well, like the confidence level is just rising. And when I look back at 2025, like my confidence level was never as high as it is now, even if the price is not reflecting that yet. So even if we are not like seeing crazy returns on a day-to-day basis, I'm still very, very confident and way more confident than I was, for example, in September or August last year. So I'm 100% on your side on this one. So,
but one of the biggest whales we know, he said that he will probably buy back in February, and he was pretty right with being bearish in summer.
Yeah.
So that's also something I have in the back of my head, but we are almost in February.
Yeah, and you have to also understand, like his prediction was in summer. So there,
just as a context, he's in a fund that manages multi-hundred billions.
Yeah, like the information that he receives is very high level player. So let's put it like that. Nothing that we can trade upon, but because like we can't build a system around it. But this is, yeah, he was pretty right, 100%.
He was 100% right.
Yeah, this is very interesting what the big guys are doing. All right, I understand why they are performing better than the average Joe.
Yeah, but we still perform pretty well.
I would say we outperformed.
I think so too, because we outperformed cash.
Yeah.
But anyway, yeah.
All right. So now we are sitting on a pile of preserved cash and gold profits. Bitcoin volatility is compressed to historical lows, which means an explosion is imminent. What is the exact trigger? Is it a final flush to 70K or breakout above 95K that makes us push the all-in button for the 2026, hopefully bull run?
Well, that question is a little bit biased, but yeah, that was I was highlighting that at the end of December, and if you look at the chart, volatility was compressing like crazy. There's a lot of simple volatility metrics you can use. There's the D-vol, the implied volatility, Bollinger Bands. I think everyone heard about the Bollinger Bands. They were like almost together, which means that high volatility was incoming. And now we saw last week, actually, we saw some volatility expansion. Bitcoin went from 88,000 to pretty much 95,000. in a few days, and it looks like the volatility might continue. So that was more towards the end of December.
Yeah.
Now volatility is slightly expanding, but we are still in the range between 80,000 and 95,000. And, I'm positioned for either, like if we go up, we will allocate super aggressively. We already have some new allocations since a few days. But if we were to go down, man, like it's cash and gold once again. It's what it is. It's gold, maybe, perhaps, because it's still in an uptrend. But
Yeah, gold's
time will tell. But yeah, basically, Bitcoin is compressing in a very tight range. And often, if you have that, it means that there's going to be a volatility expansion, which means that price will move up and down more aggressively. And we are seeing the beginnings of that. Today is the 11th of January, right? So let's see where it's going to go.
Yeah, maybe like one thing that we can add here, because there was also a volatility compression when, I think, end of September. Was it end of September or end of October?
Yeah.
So I can imagine that some people might think, okay, why is this bullish volatility compression?
I never really said that, to be honest. I just said that there's a big volatility compression and it can go either way.
Yeah, okay.
I think, because of the reasons I told you before with global liquidity, etc., that the volatility expansion will lead to a rapid repricing of Bitcoin to the upside, but it doesn't necessarily mean that we will go up.
Yeah.
It can also be that we will have a huge crash now.
This is true. For me personally, when I did like a lot of back tests, there is like, when you look at like the situation we had back then, there were more factors pointing to a bearish volatility expansion, or basically to a bearish price action through the volatility compression. Because for me personally, I would say looking only at volatility is not the main way to go. You always have to put it into context. And right now the context is just overly bullish, which doesn't mean that it will 100% go this way. But back in the days, it was 99% bearish, I would say. So like the context was 99% bearish.
And also, because I'm super nice, some additional alpha. If you look at the BTC USD longs from Bitfinex, which is pretty much the platform where most of the OG Bitcoin whales are trading, meaning the most experienced and rich whales are trading on Bitfinex. And typically what we're seeing, once the BTC USD longs are crossing below the 50 moving average, this is often the beginning of an uptrend. But right now, we barely crossed it. We didn't really have a convincing breakdown, but in the next week, if we were, around here, I think it's a pretty confirmed uptrend, right? I will explain it another time. Maybe you can explain it in your reels. So make sure to stay tuned and watch watch Robin's reels. But that's a very good sign, which I like personally as well.
Yeah, we're basically giving away all the alpha.
Yeah, that's a lot of alpha, guys.
And now we are in a position where we
give them the gold position of this alpha.
Yeah, this leads me actually to the last point. Now, we have been talking about the things that we have been monitoring, and you already said, like, we are always starting to position ourselves in the crypto space. Should we share the exact positions? I would say, because there are open positions, we can't really do that. Just know that we are back in crypto. It's a rather aggressive positioning.
80% of the portfolio and 20% is in gold, so that we can hedge our crypto exposure, because gold lately has been almost negatively correlated to crypto. And if you want a solid portfolio, you want two assets which are in an uptrend, which are negatively correlated, so that when the one goes down, the other goes up, and it doesn't drag your portfolio down, because you want to manage the downside risk. You don't want to lose money on your portfolio. So that is why this we can still disclose. We have the 20% gold position to hedge ourselves, but we have two other positions which take up 80% of the portfolio, allocated to crypto, ready to lift off and go to the moon, or maybe also to be a false signal, and then we go back to all in gold or cash. But as of today, and this can change tomorrow, big disclaimer, allocation to crypto.
Yeah. And yeah, with that being said, I hope this podcast was valuable to you and gave you some insights into how we worked throughout December. Now, if you want to know what those two positions are and want to understand how to build such a system yourself and actually get all the alpha charts that Jack is looking at each and every day, you will find a link to our program in the description. And yeah, just go through the application, and then we have a chat, see if this is something that can actually help you out. And if not, we part ways, and I still help you and give you some more alpha in the 1 hour session that we will have then. And yeah, with that being said, see you in the next episode.
See you in the next one, guys.
Cheers.